Stop everything for a moment and pay attention. If you're renting an apartment, buying overpriced coffee every morning, and telling yourself one day, I'll be financially free, you're already losing the game. Not slowly, actively. It's 2026, and the economic rules have changed permanently. Interest rates aren't going back to zero, the safety net is gone, and the middle class, it's being erased line by line. Here's the uncomfortable truth. If you don't own assets, you are one. You are the expense on someone else's income statement. You work, they profit. You save, inflation eats it. And while you sleep, your money does absolutely nothing. That should terrify you, because if your income stops when you stop working, retirement isn't delayed, it's impossible. Financial freedom is not motivation. It's math. I didn't build wealth by being optimistic. I built it by being disciplined. Every dollar I own has one job: produce more dollars. If it doesn't do that, it's fired. I don't invest in feelings, dreams, or headlines. I invest in cash flow, predictable, measurable, repeatable. And today I'm going to walk you through exactly how I would build a $5 million real estate portfolio in today's economy, without gambling, without hype, and without hoping the market saves you. But before we go any further, understand this. Information is the most valuable currency in 2026. If you miss the right data, you lose years. If you miss the next move, you fall behind permanently. That's why this channel exists. Now let's destroy one of the biggest lies ever sold. Your primary home is not an investment. For most people, it's a financial anchor. They pour their savings into a down payment, lock themselves into 30 years of debt, and then call it success. In reality, that money is trapped. It can't grow, it can't compound. It just sits there while taxes, maintenance, and insurance drain your cash flow. Investors don't buy homes first, they buy income first. I don't purchase a personal residence until my investments can pay for it. When I look at real estate, I don't see kitchens and backyards. I see numbers. I focus on multifamily properties, 4 units, 8 units, 16 units. Why? Because risk is spread. One tenant leaving does not destroy cash flow. Single-family rentals are binary, occupied or zero. That's not investing. That's exposure. Every property I buy must behave like a dividend stock. If it doesn't pay me monthly, I walk away. That means understanding net operating income, NOI. If the income from the property doesn't exceed debt payments by at least 25%, the deal is dead. In 2026, I want cap rates that beat government bonds by a meaningful margin. If the return barely clears risk-free rates, the asset isn't worth the stress. And let's talk about debt, because avoiding it is exactly why most people stay poor. Debt isn't the enemy, misusing it is. Poor investors borrow to consume. Rich investors borrow to acquire. If I can borrow money at 6% and buy an asset producing 9%, then being paid to use leverage, that spread compounds. That's how portfolios scale. You don't need $5 million in cash to build a $5 million portfolio. You need intelligent leverage, strict cash flow rules, and discipline. But leverage only works if the asset pays you. Cash-on-cash return matters more than appreciation fantasies if the numbers don't hit at least 12% annually. I don't negotiate, I leave. Location matters just as much as math. In 2026, investing in high-tax, landlord-hostile states is financial self-sabotage. You're fighting the market and the government at the same time. I follow population growth, job migration, and capital movement. Where businesses go, money follows. Where money goes, rents rise. I don't invest emotionally. I invest geographically. I don't need to live near my properties. I need them to perform. Why I hire professional management and replace them instantly if performance slips. Real estate should feel passive. If you're fixing toilets yourself, you don't own assets, you own a stressful job. Technology separates winners from amateurs now. AI-driven property management, automated screening, smart energy systems. These aren't luxuries, they're advantages. Reducing operating expenses by even 10% can add tens of thousands in annual profit across a portfolio. Efficiency is leverage without risk. And here's where real wealth is built. You don't get rich by selling assets. You get rich by refinancing them. Selling triggers taxes, refinancing unlocks capital, tax-free. The strategy is simple but powerful. Buy undervalued properties, improve them, stabilize income, then refinance at a higher valuation. You recover your original capital while keeping the asset. That money funds the next deal. Rinse, repeat. Executed correctly, this cycle compounds faster than salaries ever could. Over time, equity multiplies, cash flow grows, and eventually, the portfolio reaches scale. A $5 million real estate fortress isn't luck. It's math, patience, and execution. Most people won't do this. They'll stay comfortable. They'll complain. They'll wait for conditions to improve. They won't. The system doesn't reward participation. It rewards ownership. So the question isn't whether this is possible. The question is whether you're willing to stop being a consumer and start being a capitalist. In 2026, there are no safety nets. Only systems you build yourself. Choose accordingly.